All righty. Welcome back. Accounting 651, Corporate Organizations and Formations, Part 2. Debt versus Equity. All right. So, 1032 exchange of stock for property. Let's start there. There's a non-recognition clause. So this is, as we discussed in the very first slide back in Part 1, when a corporation issues its own stock in exchange for property or cash, there is no gain recognized. No gain or loss recognized to the corporation on the receipt of money or other property in exchange for stock. No gain or loss shall be recognized by the corporation with respect to any lapse or acquisition of an option or with respect to a securities future contract to buy or sell its stock. So corporate transfer of stock for property makes sense in a 351. How about when stock is transferred for services rendered by a vendor? And what would the basis, what basis will the corporation take when stock is issued to a non-controlling shareholder? Okay. So under Section 118, gross income does not include contributions to capital. So think of this is when someone is contributing to the corporation, but they do not receive additional shares back from the corporation itself. So if that's by a shareholder, to the extent it's voluntary, so it's not forced, and it's pro rata by existing shareholders, then it's covered by 118, and there would be no gross income on the part of the corporation. Non-pro rata also enjoys the same benefit, but you have to be careful to make sure that it doesn't look like there's some other kind of transaction going on, right? Is there a shift in ownership or something? Are you buying the shares of a different shareholder by contributing more capital? So you got to be a little bit careful. Contributions by non-shareholders, this is new under the Tax Cuts and Jobs Act for 2018. Those are gross income now. So those used to also not be gross income. And you just took a zero basis in the property, but that's no longer the case. So X is the sole shareholder of the corporation and has a loan outstanding to the corporation. So the corporation is struggling, and so X forgives the debt. That is not a 118 transaction. The corporation does need to recognize cancellation of debt or forgiveness of debt income for the debt relief in excess of the shareholder's basis in that debt. So if X's loan is $1,000, then X's basis is the loan is $1,000, and there would be no cancellation of debt income. It's only if X's basis is less than the face amount of the debt. So if that would happen if X is a cash basis shareholder and debt is accounts payable by the corporation, then in theory X has no basis in the accounts receivable, but that's a pretty rare event, so we're not going to spend any time on it. Contributions by capital by a shareholder treated the same as under 351. Carryover basis plus any gain recognized by the transfer. Contributions by non-shareholder are not treated the same. The basis of their shares is the fair market value. Contribution to capital by the sole shareholder is treated like a 351 exchange, right? Carryover basis is just added to the existing basis in the shares. So this means that if you're a wholly owned corporation, you can contribute capital kind of whenever you want. It's always a 351 transaction because you always have control afterward. Okay. 351 yields carryover basis, no gain or loss. That's the idea. A sale would, of course, yield a gain and maybe a loss, depending, and a step up in the basis of the property contributed. So this is especially relevant for gains, since recall that the gain is going to be taxed twice. So can you have an integrated exchange and sale? So you can forget sale treatment. Non-integrated avoids the exchange for stock, avoid control, use boot, or avoid characterization as a contribution of capital. So you could be in an instance where you actually want sale treatment. That's possible. All right, one planning option is to have the corporation issue debt and shares to the transfer, because debt is treated as boot. You just got to beware of the pitfall of the installment sale method. There are other limitations. So if the corporation is thinly capitalized, then what value is that debt? It's going to feel like an equity as a result, and it's going to be treated like equity. Section 1239 treats sales of depreciable property between related parties as ordinary. So if you're a greater than 50% shareholder, you got to be a little careful about trying to get sale treatment because you may not get gain treatment. You may have to treat it as ordinary. Of course, you always have to be aware of recapture, depreciation recapture. And to the extent it's a loss, 267 disallows related party losses. So it makes it quite difficult to navigate sale treatment between a shareholder and a corporation. So that can be hard to achieve. Okay. So caution on exchange where the corporation provides shares with a fair market value greater than the property transferred, because that's likely to be treated as a dividend, right? So really the exchange assumes equal market value between what you're giving up and what you're getting. Something fishy's going on if that's not the case. Okay, so let's talk about debt versus equity, right? So what are your options for structuring a corporation's capital? So you can use common stock. Common stock can be voting, non-voting. You could have stock rights. You could have stock warrants. You could issue preferred stock. So there's qualified preferred stock, there's non-qualified preferred stock, there's convertible preferred stock, and there's also debt. And debt can be convertible or non-convertible and can take many forms. Bonds, debentures, notes. Oh, excuse me, I had to sneeze. And trade payables. Gosh, I hope that wasn't really loud. If it was, I apologize. So you got to contemplate these differences for a moment. Because interest on debt is deductible to the corporation, whereas dividends paid are not deductible to the corporation. The repayment of debt constitutes a tax basis recovery to the lender and not a dividend distribution. Redemption of the stock can be an ordinary dividend, not a capital gain event. And bad debt deductions may not be a capital loss. Now, worthless stock generally is, though. So you can see there are differences between what would happen in the outcome if you're either an equity investor or a debt investor. So let's look at the power of leverage for a second and see why debt can be so popular. So if we have a corporation and we decide we're going to capitalize it with all equity, total assets of $1,000, equity of $1,000, operating income is $150. So the asset throws off $150 of income. It's all taxable. I have a flat tax of 34%. It really should be 21 today, but that's fine for this example. After-tax income is 99. Your return on equity is 9.9%. But if, on the other hand, you capitalize this half with debt, half with equity, operating income is the same, but let's assume that you have to pay interest, and interest is at a healthy 10%. That's quite a bit. The taxable income is only $100. But notice that that helps because the tax is lower. So even though the after-tax income is only 66, the return on equity is 66 over only 500 because half of it is the bank's money, which means that the ROE is much higher. Now, leverage, of course, increases risk, but you can see that it also leverages up after-tax profits. And that is in part because you're using someone else's money, and two, interest is deductible and dividends aren't. Okay, so if debt and equity were taxed the same, we would be done. But they are not taxed the same. So an equity owner, is taxed, think of it twice, right? So they're taxed at the corporate level, and then again, whereas a debt owner is taxed only once, right? Because the corporation takes a deduction, but interest income is generally ordinary income, so it's potentially taxed at a higher rate. So if this is true, then why do firms ever pay dividends, right? Maybe all firms would be better off if the earnings just capitalized inside the stock. But of course, we have rules like the accumulated earnings tax and the personal holding company tax that prevent corporations from doing so. So to some extent, they have to pay dividends. But really, that is a less tax optimal approach to getting your money out. Other things would be, what if the corporation buys back its own stock? So when the new tax law allowed for a tax on the repatriation of dividends, whether they were coming back or not, then suddenly everyone like Apple and all these other Facebook, they all allowed their foreign earnings to flow back into the U.S. But did they pay additional dividends or pay their employees more or invest more? Well, so far it appears mostly what they did is just buy back shares of their own stock. Okay, so we have at one end of the spectrum a risky investment with the potential to share in corporate profits, right? So as those profits are generated, they're passed out through dividends. You have voting rights and plenty of upside potential, right? That's on the equity end of the spectrum. On the debt end of the spectrum, you basically have an unconditional promise to pay back contributed funds, right? So you get your debt back, plus a market rate of interest at a fixed, or it could be variable rate of maturity, but it has a fixed maturity date. So in this case, you're an outsider. You get no voting rights, but you also get no potential to share in the growth, right? Your return is a fixed return. And then there's kind of everything in between, right? Preferred, convertible preferred. These are all hybrid versions that have some elements of debt and some elements of equity. And so which one are they? So as the lawyers got creative, the IRS had to try to respond. So Congress issued Code Section 385 and said, look, these are the factors that you should be considering when you're trying to decide whether something is debt and therefore throws off deductible interest, or is something equity, which means no, it's a non-deductible dividend. So look at the form of the obligation, right? What existence of the indicia of debt is there? Is there a promissory note? Are bonds issued? What is the debt equity ratio, right? Because if the corporation really doesn't have the ability to pay back the debt, then what difference does it make if there's a fixed interest rate or a maturity date or any of that? It just can't pay it back. So that feels more like equity. What if the intent is to create debt, right? Is the interest actually paid? Does it have reasonable terms? Was it issued proportional to ownership, right? So if equity and debt are issued in the exact same proportion by each shareholder, then is it really debt, or is it just an instrument that feels like equity? And then lastly, what is the level of subordination of the debt to other debt, right? So if you think about it, if there's debt being issued by a corporation and it's third or fourth subordinate to other debt, then what is the likelihood upon liquidation that you actually ever see any of that debt getting repaid to those creditors? Again, that starts to feel like equity. So other issues, right? So other things to consider. And this was under a revenue ruling they issued. So that unconditional promise to pay on a fixed maturity date that is in the reasonably foreseeable future, right? So is a 99-year bond a bond, or is that equity, right? Because who lives for 99 years? It's whether the holders of the instrument possess the right to enforce the payment of principal and interest, right? If it's payable in stock, that almost certainly means it's equity. Whether the rights of the holders of the instrument are subordinate to the rights of general creditors, whether the instruments give the holders the right to participate in the management, whether the issue is thinly capitalized, whether there's an identity between the holders of the instruments and the stockholders, right? So that's the proportional. What is the label? Like the form over substance. And whether the instruments are intended to be treated as debt or equity for non-tax purposes. So, for example, regulatory rating agency or financial accounting. All these are factors to consider. So, of course, firms are frequently looking for debt classification for tax because of the deduction, but equity classification for books. So Congress passed 385, and within Code Section 385, it says that the Treasury is eligible to issue regulations to help interpret what these rules mean. So they issued proposed regs in 80. They were all withdrawn in 83. They issued them again in 2016. It had been, I can't even do the math. That's how long that's been. 36 years, 33 years. They finally issued new regs. They were highly controversial. and they were withdrawn. So that was one of the first things the Trump administration went after is let's get rid of the new 385 regs. So they are officially on hold again. So what about the treatment of shareholder guaranteed debt, right? So can that be recharacterized as an equity contribution? And there's a Plantation Patterns case, and it says yes. If the company is inadequately capitalized and the shareholder is guaranteeing the debt, then in substance, they're the borrower, and as a result, that's probably equity. All right, so A, B, and C form Cafe Inc. to operate a restaurant previously operated by C as a sole proprietor. So A and B are coming to the table and they're saying, look, we're gonna partner up, maybe raise capital, do whatever. So A contributes $80,000 of cash, so he's a capital investor. B contributes a building with a fair market value of $80,000 and a basis of $20,000. C contributes $40,000 in cash, and of course the goodwill from his existing business. And all parties agree that the value of that is $40,000 and its basis is zero because self-created goodwill generally has zero basis. Each of them get 100 shares of Cafe stock in return. The thing is, Cafe needs another 1.8 million. So maybe they're going to franchise, maybe they're building a new fancy restaurant. Who really knows? It's not that important, right? So they're going to get a $900,000 loan from Outside National Bank, and that has reasonable rates and terms. And the loan is secured by a mortgage on the building. And then they raise the additional debt from A, B, and C, $300,000 each with a 5-year maturity at prime minus 1%. And so we have to ask ourselves, are those truly loans or are they equity? Because again, this matters with respect to interest and deductions and dividends and all the other treatment. So the assets after the loans are cash of $1.9 million and a building of $20,000. So the liabilities are $900,000 to Outside and $900,000 to ABC. That's so think of it like that's what the balance sheet looks like when we're done. So the form of the shareholder debt looked reasonable, right? It had a prime rate. It was pegged to a normal interest rate. It had a 5-year maturity. So you'd say, like on the form perspective, that looks pretty good. However, it was proportional, right? So the debt was issued proportionally to A, B, and C, which means A, B, and C can dictate the terms of payment, and it starts to feel like equity ownership. The debt to equity ratio doesn't bode well for debt because debt is $1.8 million and equity is merely $240,000. So debt to equity ratio is 7.5 to 1. That's pretty high. From an intent perspective, it seems like the parties intended it to be debt. From a subordination perspective, it doesn't look like there was no mention of it was being subordinate to the bank debt. So, what we run here is some strong risk of equity due to the proportionality and the thin cap, right? So the rules don't say, well, if 3 out of 5 are debt, then it's debt, or if 3 out of 5 are equity. It simply says these are the factors you have to consider. We don't even know that they're equally weighted factors. All we know is that these are the factors we're supposed to consider. That's why we really wanted regs. Okay, so avoiding attributes of hybrid stock, right? So how do we make sure that we claim debt and we keep it as debt? Well, it needs to have a reasonable interest rate. It can be fixed or floating, but there should be a reference to an external rate, right? It shouldn't be, of course, based on like the earnings of the underlying corporation. The interest, of course, should be paid with regularity. It should, in fact, have a fixed maturity date and no convertibility feature. It is very difficult to avoid equity status if you have proportionality and the debt is deeply subordinated to other debt. Okay, so one more thing before we go. There is a limit on the deduction of interest. Well, I guess it's not right before we go. And the limitation is it applies to any corporation for disqualified interest. Okay, so this is if they have excess interest. Excess interest is defined as the ratio of debt to equity of such corporation at the close of the taxable year exceeds 1.5 to 1. So for a corporation organized in country A, wholly owns USCO, a corporation organized in the U.S. Forco's investment in USCO stock totals $6.5 million. In addition, USCO has borrowed $8 million from Forco and $5 million from an unrelated bank. In 2010, which is USCO's first year of operations, USCO's adjusted taxable income is $1 million, none of which is from interest income. And it also pays $400,000 of interest to Forco and $300,000 of interest to the bank. Under the U.S. Country A Income Tax Treaty, no tax is owed to the U.S. on the interest payments made by USCO to Forco. So USCO has a 2-to-1 debt equity ratio. Total borrowings of $13 million, total equity of $6.5 million. So USCO's deduction for the $700,000 of interest it paid can be limited under this 163J rule. USCO's disqualified interest is $400,000. That's the amount of interest paid to a related party on which no federal income tax was imposed. The excess interest expense is that $700,000, so total, minus $1 million, which is their taxable income, times 50%. So that means their excess interest is $200,000. Accordingly, they can only deduct $500,000 of interest expense for the year. The additional amount can be carried forward and deducted in a subsequent year with whatever the excess limitation is for that year. So this is just a way of preventing massive deductions for interest for when that debt is between a related party and that related party is generally foreign, right? So it's called interest stripping because what you're doing is stripping income out of the U.S. and in theory shifting it over to a low tax jurisdiction, right? Obviously, if Forco is organized in a country that has a high tax rate, this is not an issue, but no one would do it. Okay. So no gain or loss by corporation on issuance of debt or equity generally, right? Equity and debt securities held by investors are generally held as capital assets unless you're a trader, and you generally receive capital gains treatment to the extent that they're sold, redeemed, or retired. The purchase of equity debt by the issuing corporation. So some stock redemptions can be treated as dividends, and we'll cover that later. Some redemptions are treated as a sale, and that therefore would result in a gain or loss. Debt is definitely treated as a sale, and therefore you recover basis. So that's the early extinguishment of debt gains and losses. Okay, so worthlessness of the stock. What happens if you're holding stock and it becomes worthless? So capital loss treatment generally upon sale or becoming worthless for non-corporate shareholders. So you treat it as sold for zero on the last day of the tax year, it's declared worthless. For corporate shareholders, it's the same unless it's an affiliated company, and then you treat it as an ordinary loss. So that's equity. What about if you have loss on debt that's evidenced by a security? If you've held that security for more than 1 year, you get long-term capital gain loss. That's different than if it's not held or it's not evidenced by a security, because that's just called bad debt. Business bad debt is an ordinary loss. Non-business bad debt is treated as a short-term capital loss. So what this means is that due to differing treatment, classification is important, right? Non-business debt is debt other than a debt which is created or acquired in connection with the taxpayer's trade or business, a debt, the loss from the worthlessness of which is incurred in the taxpayer's trade or business. So there was a court case called Whipple, and it's not Mr. Whipple who squoze the Charmin if you're old enough to remember those commercials. And it said, look, you can claim a debt as a business debt if you're in the business of money lending, you're in the business of organizing, promoting, financing, selling corporate enterprises. If that is its business, if it's in an effort to protect or advance the taxpayer's business as an employee, or if it's in an effort to protect the taxpayer's credit rating in other businesses, or in some other commercial relationship. Otherwise, it is a non-business debt. So, loans to a corporation as employee. The issue is that business or non-business debt, because that will change the value of the deduction. So Generous, who owned 44% of the stock, and was the part-time president with a salary of $12,000. He advanced funds to the corporation and also guaranteed corporate debts. The court held that Generous's dominant motivation was as to make an investment, not to protect his employment status, therefore his business. As a result, business was not the dominant factor at the time the loan was made, and not when it went bad. So as a result, that is a non-business loan. Okay. There's a little code section called 1244, and the intent of 1244 is to equalize corporate form versus non-corporate form. So let's say, for example, that you start a business, right? And it's a sole proprietorship. So you go out and you buy, equipment and machines or buildings or whatever it is you need to operate your business. And that's all business held, used in trade or business, but it, of course, is not in corporate form. And then it fails, right? So the presumption is you sell everything at a loss. So there's no recapture. And that loss is treated as an ordinary loss, right? Because under 1231, trade or business property, if it nets to a loss, is treated as an ordinary loss. So you would take an ordinary loss for the failure of your business. But if instead you organize that business as a corporation, now what you own are shares, and those shares would become worthless. And so the rule says, well, look, we want to try to create, again, neutrality to the extent we can between different organizational forms. So section 1244 is there, and it says, look, you can take an ordinary loss deduction of up to $100,000 if your small business fails, just like this. So what's it small business mean? Aggregate cash and property transfers less than $1 million. You have to have been in an active business for the 5 preceding years. There's an annual limit on the ordinary loss amount, and you may not use a double loss feature if lost property was contributed, right? So if you contributed lost property, of course, you can't double down and take both. Okay, that does bring us to the end of the Chapter 4 lecture. I do appreciate you guys listening in.